You're listening to the Cash Podcast, creating affluence, success, and happiness with your financial surgeon, Adam Koos, President and Portfolio Manager at Libertas Wealth Management Group at libertaswealth.com.
Hey everyone, one of the things that people don't know, or many people don't know about me, is that I have two majors from my college years. I have a Bachelor of Science in Finance, but I also have a Bachelor of Science in Psychology. I always joke that oftentimes I feel like I use the psychology degree more than I do the finance degree, but that's one of the reasons that is because of what we're going to be talking about today. So if you saw in the title, Be Honest, Are You Biased? I think most of us are biased. In fact, I'd be hard-pressed to find anyone that doesn't have any biases. So in fact, I'd be willing to bet that most of us have several biases. So that's what we're going to be talking about today. We're going to be talking about all kinds of different biases, how they affect our decision-making, our investment decisions, our retirement planning decisions. And we're going to talk about the differences between cognitive biases and emotional biases. We're going to talk about biases that you can fix and how to fix them. And then we're going to talk about biases you can't fix and what to do about that. So before I get started, though, I want to tell a quick story. When I was just getting started in the financial markets, I assumed that the number one goal was to be right. Pick the right investments, pick the right asset classes, pick the right sectors, pick the right entry points, sell at the best times possible. But, my experience during the market crashes of 2000 to 2002, 2007 to 2009, and then even the COVID crash taught me that the real game is not about being right, but rather to admit when you're wrong. A strange thing happens to our brains when we start to realize we're wrong. Your brain will go to colossal lengths to try and protect your fragile ego, even convincing you that you're not really that wrong and you probably shouldn't do anything about it, and it's basically just going to work out fine. But as one of my former mentors used to say to me, he used to say, it's okay to be wrong, it's just not okay to stay wrong. So as we talk about all these biases, I think it's important to understand that it's okay to have these biases. It's just a matter of A, understanding which biases apply to you, B, being aware of those biases when you're making decisions, and then last but not least, and really most importantly, making sure that you have solutions or ways to get around them so they don't affect you negatively when it comes to your investment decisions and, of course, your retirement planning and long-term success. So before we jump in, quick housekeeping item. Obviously, check us out on YouTube, on iTunes. We are on both. If you're a listener, we're on iTunes. If you're a watcher and you're watching this right now, then obviously you're on YouTube. We have two separate pages. Obviously, it's the Cash Podcast here, which, by the way, is going to be going through a little bit of a change in branding here at the end of the year, so be on the lookout for that. But we also have the Libertas Wealth Management Group screencasts and things that come out, I would say typically quarterly, but every once in a while we'll have something that comes out in between the quarters if something crazy is going on in the financial markets. But you can also follow me on Twitter at Adam Koos. That's at Adam, Koos as in Sam. And I'm on Instagram at Financial Surgeon. Of course, last but not least, all links, visuals, charts, and other educational resources are always available on our website. So let's go ahead and jump in here and start talking about these biases. I always like to start, as you know, if you've been watching or listening for a long time, I always like to start with a quote of the day. And the quote of the day today goes like this: "The man who asks a question is a fool for a minute. The man who does not ask is a fool for life." So again, we're talking about egos and biases and again, emotional, cognitive biases, heuristics. So I think this one by Confucius is a really, really applicable one today. I'm not going to go through all these, if you're looking at your screen, I'm not going to go through all these right now individually and list them all out. But what I am going to do is we're going to go through each one of these cognitive biases first, the ones that you can fix. Then we're going to go through emotional biases, which are the ones you cannot fix. And then we're going to go through what they are. We're going to go through examples. And then we're going to go through maybe things that investors do as a result of these biases. And then quick asterisk here. While you can fix the cognitive biases and not the other, in both instances, these biases cause investors to either hold investments for too long, generally speaking, or they cause investors to fail to diversify and minimize the risk in their portfolios, their retirement portfolios. So let's jump into the first bias. The first one is called conservatism bias. These are all cognitive biases we're talking about first, by the way. These are ones you can fix with proper training, time, practice. The conservatism bias is where investors overweight old or initial beliefs and then underreact to new information. Some consequences would be, they hold on to investments and or they're too slow to react when things change. Example would be investing based on FDA approval for let's say a biotech stock, but then not reacting when the company announces that they're having difficulty with the FDA. In other words, you hold on to the stock even though things have changed. Another example of a consequence would be, investors deciding to maintain a prior belief rather than dealing with the mental stress of processing the information that they've just found to update and or change their position. In other words, it stresses them out. They'd rather just, put their head in the sand and move on. It's almost like a laziness, head in the sand approach, which obviously isn't good when it comes to our hard-earned retirement savings. So that's conservatism bias. The next cognitive bias is called confirmation bias. This is where investors look for information that confirms their beliefs. Again, confirmation bias. So they look for information that confirms their beliefs while ignoring or undervaluing information that contradicts their beliefs. So consequences to this would be looking for articles, news, or other research that confirms why they should keep an investment rather than looking for information to justify selling it. It can cause the investor to consider only the positive information about an investment and avoid all the negatives. So that's confirmation bias. I'm curious as we go through these, start thinking about, does this apply to me? Is this something that I do, or is this something that, in my mind, I tend to fall victim to? The next one is called representative bias. Now, representative bias is classifying new information based on past experience. So it's using your past experiences and your life experience to classify brand new information and almost categorize it. So investors might think to themselves, oh yeah, this is like when I invested in 2008, or this is like that investment I bought back in 2004. Consequences would be new information could be different, obviously, but this bias keeps people from seeing it that way. And even though it's different, it doesn't make a difference. That people tend to categorize it as something they've seen before. And when the new information is received, so the new information is received by the investor, they quickly and automatically simplify it versus implementing proper research. So in other words, it's almost like a bias that causes shortcuts. An example would be, analog or historical charts, which we call in Twitter, financial Twitter, FinTwit, we call it chart crime. And what I mean by chart crime, it's things that when people post charts that are just wrong or bad analysis, they're using, it'd be easier to show you one, which I don't have an example here on YouTube today, unfortunately, but I'll talk you through it. So, an example would be like an analog chart or historical chart from 2008, which we're seeing a lot of these charts, by the way, from 2002. The market crashed 2000, 2001, 2002, and people are comparing it to now, and they're literally overlaying the chart right on top of the old 2000 to 2002 chart, kind of almost expecting that the past is going to literally repeat itself exactly like it was before. So that's an example of representative bias, is where historical charts, analog charts, are compared to what's going on today, and then people assume that the future is going to repeat the past just because it looks similar to what they've experienced before. The next bias is called illusion of control bias. This is believing that one can control or influence outcomes that they have absolutely no control over. It's the power to choose. In other words, because we have the power to choose and we have an active involvement in our portfolio management, our investment decisions, those things inflate our confidence, and then it causes investors to gamble more when they choose their own lottery tickets, for instance, than when they select their own. It causes people to gamble more when they choose their own lottery tickets compared to when they're selected for them at random. So if I remember when I was a kid, my uncle used to always buy lottery tickets, and you could hit the random button and that would generate numbers for you, or you could pick your own. Now, he would always do both, of course, but people tend to gamble more and buy more tickets when they can pick their own. This is what this whole illusion of control, which obviously I think most of us know, rationally, that we can't control the markets or what an investment does after we buy it. But again, there is this bias that exists that makes some people, not everyone, some people have this bias where they get this idea where they can control things. Now, they're not telling themselves that. It's just, again, it's a bias. It's almost subconscious. So consequences would be, it causes investors to be antsy. It results in the investor feeling like they need to make more changes to their portfolio than they should because they feel like they have control. And if they make a change, then that's implementing that control over the outcome, which is obviously not the case. The next bias is called hindsight bias. You've probably heard this one before. This is when investors see past events as having been predictable and reasonable to expect. So they look back. It's another phrase for this you may have heard is Monday morning quarterback. So they tend to recall their predictions when they predicted something as more accurate than they actually were in real time. So some consequences are the fact that humans don't have a perfect memory results in the brain reconstructing gaps with the information they prefer to believe. So we can't remember things perfectly. So when people go back to, the 2007, 8, 9 crash, I've heard people say, oh yeah, I got out of the market right close to the top. Well, it probably wasn't close to the top at all, but you're remembering it that way. And as time's gone on and as you've told the story over and over again, perhaps, again, if you have this bias, you remember it that way when perhaps it wasn't the case. Another consequence is it causes investors to overestimate the degree to which they predicted an investment outcome, which gives them this is terrible, but it gives them a false sense of confidence going forward. It's one of the worst things that you can do when you're investing is to, first of all, pick an investment, sell it, make money, and then think it was all because of you. In other words, it had nothing to do with anything else. It wasn't the market. It wasn't the economy. It wasn't the sector in question or the industry group. It was you. It's like this God complex where you made this investment and you're so great because you picked such a great investment and look how great you are. And it goes the same for an investment maybe you purchased years ago and you look back and you go, oh, I picked this great investment and it made you feel really good. And so what ends up happening, this God complex or this false sense of confidence causes you to make more poor decisions in the future, primarily due to ego, problems with ego. So that's hindsight bias. The next one is called cognitive dissonance bias. I know it sounds really nerdy, but let me get into it here. This is when an investor goes to great lengths to defend why the investment they purchased is still the best, despite new information that contradicts their opinion. So a funny example here, if you've never seen the movie Idiocracy, I would highly encourage you not to just watch it, but to buy it if you can. You might be able to find it on some of the streaming services like Netflix or Hulu or something like that. But it's worth buying the Blu-ray or DVD just so you can share it with friends because it's such a great kind of satire on society today. But anyway, they have this stuff called Brawndo, which is basically like Gatorade, and everybody keeps watering all the plants with Brawndo because it has electrolytes, and they keep going back and forth, and they say, well, what are electrolytes? And they say, well, it's what plants crave. And they say, but why do plants crave it? And it's like, well, because it has electrolytes. And they just go back and forth and back and forth. So in the movie, water is obviously way better for plants than Brawndo or Gatorade, whatever you want to call it. But they just didn't believe it. And they figured they're crazy. They couldn't believe that you would take water from a toilet, as they put it, and water plants with it. Why in the world would that help plants grow? But, this is a movie about where the world is going to be in, 500 years from now. And basically the premise is that we're all stupider in the future, unfortunately. So hopefully it doesn't come true. Hopefully it's not a documentary. But I digress. So some of the consequences of cognitive dissonance bias are, it causes investors to do something called averaging down. You may have heard that before. Averaging down is just buying more shares or buying more of an investment and putting more good money after a bad investment that continues to fall in value. Again, remember, cognitive dissonance is, dissonance bias is when people go to great lengths to defend why they purchased an investment. Again, think ego here. And they think it's still a great investment. And so as it goes down, they just buy more. And they think, well, I'm buying more shares and I'm averaging down my price. But they're buying potentially an investment that's in a downtrend and it's not going to come back. It can also cause investors to follow the herd or follow the herd mentality, even though obviously this is counterproductive. I think most of us know this. And this bias it causes investors decisions that we hear so much about at peaks and troughs in the market. In other words, it's what causes investors to sell toward the bottom of a market crash and then either not buy until much, much, much later. It also is what causes investors to, quote unquote, wait for things to get better before they buy. In other words, wait for prices to get higher. And then when prices fall, like they have this year, they say, well, I'm going to wait for things to get better before I invest. And then when things do get better, let's just say 6 months from now, a year from now, this whole bear market's over with, they'll say, well, I don't want to buy at a market high. So it's back and forth, back and forth. So that's cognitive dissonance bias. The next one is called anchoring or adjustment bias. This is really, really closely related to conservatism bias, so you're going to start to see some overlap with a couple of these, but they are different, and there's differences between all of them, sometimes small differences, but this is, again, where people overweight the pasts. This is, when people are presented with new information and they're being asked to make an estimation they'll always start with an initial number, and that number is called the anchor. And then they rarely adjust that number. So a real simple example would be, investors putting too much weight on round numbers, like, Dow 30,000. I want to, if the Dow goes below 30,000, then I'm selling. Or if the Dow goes above 35,000, then that's a good thing. Well, who cares about Dow 30,000? What's the meaning there? And there really is very little meaning aside from the fact that other people with this bias may be anchored to that same number. Aside from that, nothing matters about Dow 3000. It also causes investors to stick with their original estimates and that anchor, and they fail to move or change that number. It causes analysts. So when you look at analyst upgrades, downgrades, when you're online and you're seeing whether analysts are offering a buy or a strong buy or a hold or a sell recommendation on a stock, let's just say. This bias, anchoring bias, adjustment bias, it causes an analyst to wait too long before they downgrade a security that they were originally bullish on because, again, they don't want to be wrong. Remember back to that first, how we started this podcast. Nothing wrong with being wrong. You just don't want to stay wrong. So that's anchoring bias. The next one's called mental accounting bias. This is where investors value the same amounts of money differently depending on which mental account they've assigned that to in their brain. So, for instance, it causes investors to chase interest rates at the expense of growing their money. They'll neglect a good long-term opportunity because they want to reduce their risk. They might have a great opportunity cost, long-term or short-term. It doesn't really make a difference. But because of their short-sightedness, let's just say they have a bunch of cash and they're trying to get a good CD at the bank that's paying 1.75%. They'd rather get that 1.75% interest rate, even though it's getting destroyed by inflation, just because they're short-sighted, they're nervous maybe, and in their mind, that account, that money is money that just cannot be lost. And, even if they're not going to spend it, they're going to sit this money in an account and let it sit there, lose money to inflation. In other words, their real return would be negative, completely absently ignoring the future and the long-term potential growth. So they lose, and another consequence was they lose potential growth, and I mentioned loss to inflation, and they ignore it as long as they can get a good interest rate or an income stream or something like that. So they make excuses for why they shouldn't invest in something that maybe would have a better long-term return because they want to look at the interest rate or the income stream that they can get right now. There's another bias coming up, by the way, that's a little bit similar to this. We'll get into it in a second, but that's mental accounting bias. The next one's called framing bias. This is where investors answer questions differently depending on how they're asked. This is terrible to say, fake psychics do this. They're very, very good at framing and asking certain questions to get the answers they want out of you to make it seem as if they can predict things. But in this case, with framing bias, the frame that a person adopts is based on their own personal opinions, of course. So an example, I got two examples here. The first example is, let's just say you see something in a research report and it says 20% of sick people who receive this vaccine will survive. And so you think 20%, but you could also say 80% of sick people who don't receive this treatment will die. So obviously a huge difference in using the numbers inversely. Another example, this is one of my favorites from Greg Moore. Greg Morse. He said, framing, and a great framing example is, telling somebody you've got a 1 in 6 chance of winning the lottery, winning millions of dollars, 1 in 6 chance. Would you take that bet? And most people would say sure. And they said, now let's change the bet. What if it's Russian roulette? Well, of course, we have no interest in this game anymore, right? So some of the consequences of framing bias are things like chasing riskier investments in order to offset negative framing. Or another example would be investors that have this bias might buy bad investments based on how they've been framed. In other words, the data, the information, the research may have been presented in a way that inflates the value of the investments when in reality maybe it isn't all that great to begin with. So that's framing bias. The next one's called availability bias. And again, there's a lot of cognitive biases if you haven't noticed already. So these are all cognitive. These are the ones that we can fix. We can cure these, so to speak, to a certain extent. Availability bias is when investors subconsciously determine the probability of an event based on how easily they can recall their memory of that event. So an example would be, due to reporting in the news, some people feel there is a higher probability of dying in a plane crash than dying in an auto accident, which is exactly the opposite. So because the news has a tendency to report these big, low probability but sensational events, some people can be afraid to fly. I have family members like this. It can some consequences. It can cause investors to invest only in securities that they're familiar with. Because they think it risky to try and invest in something that they're not familiar with. So they might say a big example that I don't hear it as much anymore as I used to back in the 2000s. But I used to hear people say, "Oh no, I don't want to buy oil and gas investments. I don't want to buy oil and gas exploration. I don't want to buy energy investments because back in the 70s and 80s, I had these limited partnerships that I bought and they tanked, and I lost all my money." And it's like, okay, so because of something that was a bad investment a long time ago, you're not going to invest in any oil, gas, exploration, energy stocks at all? I mean, that seems pretty crazy to me, but that's where this availability bias comes in. Another example would be buying. So that's an example of when people don't buy something because of their availability of information, their memory of something. Here's an example of something that people do. In other words, they will buy because of that same availability bias. They'll say, "What about Procter & Gamble? This is, for instance, somebody who lives in Cincinnati. Procter & Gamble's there. What about Procter & Gamble or Kroger? I shop there all the time. What about Cardinal Health? I drive by it on 270 all the time around the Outer Belt." So that's another example of availability bias. The next is called self-attribution bias. Self-attribution bias is taking credit for winning investments and then blaming failures on bad luck, the article you read, the friend who gave you the tip, or your financial advisor. And a good example, having nothing to do with money, would be students who do really well on an exam taking credit for the good grade. But then when they fail the exam or they get a bad grade, they blame the examiners, the study material, the program, or something else. So some consequences in the retirement planning world, investment management world for self-attribution bias would be, again, similar to cognitive dissonance bias here, it can lead to taking on too much risk. And it causes investors to make too many changes, trade too much, and under-diversify their investment portfolio. So that was self-attribution bias. The next one's called outcome bias. Outcome bias is where investors make decisions based on the outcome of past events, based on something that happened to them in the past. So they focus on the performance outcome rather than how the results came to be. So it's kind of like focusing on a trip to Florida or a trip to California as opposed to the how you got there in the first place, whether that was by car, by plane, or what have you. So a classic example would be investors basing their investment decisions and what they buy in their portfolio based on the past 3 years, 5 years, or 10 years performance, as opposed to researching the science behind the probability of positive returns over all kinds of investments over the next year. So it's looking at past performance. It's actually, when you think about it, it's that old disclosure, right? It's the past performance is not indicative of future results. So that's one example. Another example is it causes investors to avoid investments that are poised to grow because the past performance is no good. So let's say, oh well, I don't Why in the world would I buy this investment? The last 3 years have sucked. Well, maybe it's poised to grow. Maybe it's a great time to invest. A good example of this outcome bias and how it can hurt you is how, just a year and a half ago or so, if you looked up any energy or oil and gas investment, it had a terrible rating on Morningstar. It had a terrible 3-year or 5-year return, which would mean you shouldn't buy it. But then when you look at the returns of energy, oil and gas over the last year and a half, they've been great investments to own. So that's outcome bias. Recency bias is one that comes up all the time at our office. But what recency bias is where investors place more weight on recent events and observations as opposed to the older ones. So as time passes, the perceived risks associated with events that have happened further in the past diminishes and disappears over time. And what this does to people, it causes investors to make projections based on sample sizes that are way too small. In other words, they use really recent information to assume what's going to happen in the future. And then that results in buying or selling an investment too late. And it doesn't really make a difference whether they're buying or selling, by the way, but it causes procrastination sometimes. It can also cause investors to lose focus or to become married to the price gains that are being publicized. So if they have an investment that's gone up a lot, they won't want to sell that investment because they've made money on it when maybe the trend has broken down, maybe things have changed fundamentally about the company, and it's time to cut bait, walk away, and buy something else. So that's recency bias. Now we're going to change gears here. These next few biases, there's less of them, by the way, are all emotional biases. We cannot fix these. So cognitive biases can be fixed. Emotional biases cannot. But the reason I'm sharing them with you is, first of all, so you know what they are, and so you can kind of try and figure out if they apply to you or not. And then the second thing, and the most important really, is to understand them, be aware of them when you're making decisions. So again, you can't fix these. If you have any of these next biases in this next list of 1, 2, 3, 4, 5, 6, it looks like, maybe a couple more, just be aware of them and know that you have them and know your tendencies. So the first one's called loss aversion bias. This is when investors tend to strongly prefer avoiding losses as opposed to achieving gains. It's an imbalance. So psychologically, they say, the pain of loss is too great compared to the joy of gains. The consequence of this bias is investors accept risk only to claw back losses rather than maximize their gains. So if they lose any money, they're just concerned about getting back to even, and then they just want to sell. They might hold on to losers for entirely too long, so they don't have to quote unquote lock in a loss when maybe they should have sold a long time ago. And they may sell their winners too soon and take the good money and invest it in bad money, losers. This is something called rebalancing, which I'm not a huge fan of. Rebalancing is okay in certain very specific circumstances, but the idea of buying some bonds and some international stocks and some domestic stocks and some commodities and currencies and having everything in your portfolio and over diversifying and then watching just by chance the domestic stocks go up and then selling those winners every quarter to put money into the bad stuff that has gone down. I mean, think about it. International stocks have been underperforming U.S. stocks for over 13 years. So why in the world would we keep putting good money after bad instead of just putting more money onto the good investments? Same thing could be said for Michael Jordan. Why not just keep playing basketball and focus on what you're good at instead of trying to, your hand at baseball? Now, obviously, in his case, he could do whatever he wants, right? He had all the money in the world. So if you want to play baseball, have fun. But not the best way to maybe perfect your craft if it's not your craft. So that's loss aversion bias. Then there's overconfidence bias. This is when investors put too much faith in their own abilities. Overconfidence, right? The tendency is to underestimate risks and overestimate the results that they think they're going to get. Oftentimes, those who have this bias will excessively trade in their accounts. They'll buy and sell too much. They'll fail to set stop losses. In other words, other alerts, let's just say, that might act as exit strategies to get out of an investment because being wrong about the trade seems completely inconceivable. And I see this a lot personally when I talk to people in the digital market, so like crypto space, Bitcoin, Ethereum, things like that. People have a really, really tough time, with this idea that of getting rich quick, and that if they buy it, it's going to go up, and you've heard the phrase, it's going to go to the moon. And then when things don't turn out the way that they want, they tend to hold on to it and get married to it. So that's overconfidence bias. Another emotional bias. Again, all these are emotional biases. You cannot change. You cannot fix them. You just need to be aware of them. The next one's called self-control bias. This is where investors fail to act in pursuit of their own long-term goals because of lack of discipline. The reason for this is short-term satisfaction. In other words, immediate gratification sabotages the long-term. It's painful now, but they're not willing to sacrifice today for future benefits. This could be, saving for retirement sooner. This could be having nothing to do with money, exercising and eating well, knowing that the payoff is a really, really long grind. It's going to take a while. Another example that's not up here would be, investors not understanding in the moment that there's going to be times when the market goes down temporarily, understanding that it's just that temporary. So as an example, the market goes down 3 to 5% on average 3 times a year, and the market goes through a correction, an average correction of 14% on average once a year. So that means if you've got $1 million portfolio, retirement portfolio, that you can expect your portfolio to be down. If you're in an all stock portfolio, you can expect your portfolio to be down anywhere between 10 and 14%, or in other words, $100,000 to $140,000 intra-year, and that's completely normal and it's okay. But that self-control bias causes people to sacrifice their long-term goals, freak out, throw their hands up, and say, you know what, I can't take this short-term pain. So it causes people to take too little risk sometimes. It causes people to take too much risk versus accepting smaller profits when maybe things aren't going so well. It can cause investors to hold positions for too long versus stopping out, implementing an exit strategy. And it can cause investors to overemphasize the value of, say, dividends, taking advantage of, as opposed to taking advantage of strong and steady capital growth with discipline. I've heard that, not as much anymore, but every once in a while I'll hear that strategy of, I'm buying an investment for the dividends. Well, if you buy an investment for the dividends and then the stock goes down from $100 to $50 a share, now you have half the money, and chances are they're probably going to reduce the dividend at some point, and now you have half the money and less the dividend. So self-control bias, definitely one to keep in mind. Again, can't fix it, but one you need to keep in mind and be aware of if it's something that applies to you. All right, the next emotional bias is called status quo bias. This is when investors do nothing when they should do something. So doing nothing when you should make a change. Complacency, not looking for, or worse, accepting beneficial opportunities. So when you somebody presents you with a great investment idea, or you want to make a change, and this doesn't even have to be an investment. It could be making a change in strategy or who you work with, not trying to improve your position because you're just cool with the status quo. You're just good with how things are going. You're okay with things not being well. Let's just put it. So some consequences. It causes investors to accept the easiest choice versus taking the time and doing the research to identify the best choice. A little biased myself here, but I feel like one of the biggest examples is if you're not happy with the financial advisory firm you're working with, doing the research and taking the time to interview a couple people to find someone else to improve your position. I guess this is where I have to throw in a shameless plug and say that if you aren't happy with your retirement plan, estate plan, financial plan, investment portfolio, retirement portfolio, then we offer a free second opinion. And it takes 3 appointments. First, technically, it's an introduction call first, phone call first, just to get to know each other. Then it's a discovery meeting to get all the information we need to put together a financial plan for you on the 3rd meeting. Then the 2nd meeting is an education meeting where we go over a bunch of things about investments, how we're structured as a fiduciary, what that means to you and your family. We go over some investments 101, our different strategies, and talk a little bit about risk. And on the 3rd meeting, we go over your financial plan, provide you with a second opinion on your investment portfolio. We go over a cash flow analysis, tell you whether you're on track to retiring when you'd like to have the choice to. And more importantly, whether you are retired or not, we want to make sure conservatively that, again, if you're retired, that your money's going to last longer than you do. And all this is put together along with recommendations for estate planning, retirement planning, tax planning, insurance of all kinds. And because we're a fiduciary, we don't sell insurance, so you can be assured you're going to get good, unbiased Huh, how about that? Unbiased advice. So that, and there's no cost to go through that process, by the way. If at the end of that process, we decide mutually, or you decide that we're not a good fit, then we part as friends and that's it. In fact, we know from doing this for 21 years now at this point, that if you don't want to work with us, we probably don't want to work with you either. It's no offense, it's no hard feelings, it's just not a good fit for whatever reason. So anyway, back to the biases here. Status quo bias. Another cause is holding on to a portfolio that's entirely too risky. Not making a change because you just don't want to make a change. In fact, one of my favorite quotes is, "Not making a decision is a decision." So that quote, "Not making a decision is a decision," is all about status quo. Another consequence is holding on to a portfolio that's entirely too conservative, even if you don't need the growth when their future legacy, so the investor's future legacy, like their heirs, their charities they're going to give their money to, could obviously benefit from it. So that's status quo bias. The next one's called endowment bias. This is a pretty big one, big emotional bias here. This is where investors value in an asset more when they own it than when they don't. So if they didn't own an investment and they were evaluating it, they would evaluate it more objectively. But if they own it, the investment is endowed, in other words, with more value because it's in their portfolio. And what the consequences of this bias are, investors fail to sell an investment because they want to wait till it comes back, for instance. They might get inherited stock from a family member, and they hold those positions for too long due to an emotional attachment, despite the risks of having too large of a concentration in the stock. Or maybe they won't sell it and their excuse is they don't want to pay the taxes. And we have a joke in this industry that if you don't want to pay the taxes on your investment, just wait long enough and the market will take care of your gains and you won't have to pay your taxes. Another consequence, holding on to investments that you're familiar with because your understanding of that investment causes you to value it more. So that's endowment bias, and it's a big one. I actually see that quite a bit. The next one's called regret aversion bias. This is when investors avoid making a decision out of fear of making the wrong one. It keeps investors in a bad position for too long, out of fear of walking away. Like, what if I walk away and it comes back, or it does better and goes up? It also causes investors to miss opportunities due to fear that it might not work out. So if there's a good opportunity, they might say, you know what, I'm not gonna buy this because if I buy it, it might go down. So that's a regret aversion bias. Some consequences. It's not already obvious. It causes investors to hold a position too long because they're worried it's going to come back or that grow to new highs, and that they're after the fact they're going to wish they would have kept the investment. It creates a situation where the investor becomes overly conservative, particularly after a string of losses. So if they've had a couple, kind of a stroke of bad luck, or the market's gone down, for 6, 12 months, 18 months, it causes them to get overly conservative, and it changes their investment philosophy completely, potentially permanently. And it also makes investors susceptible to herding behavior. So an example is they might say, well, if my portfolio's down, everybody's losing money now because this market's down, so who cares, So that's an example, again, of regret aversion of bias. The last one we have here today is called affinity bias. Affinity bias is when you've got people who make investment decisions partly or wholly based on their values. So this is an example of, somebody says, I own Tesla and I want to buy Tesla because it's an electric vehicle and I like electric vehicles because I want to protect the environment and whatever the case is. Now, Tesla's been a pretty good investment, so that's worked out. But there's several other investments. I could go into the solar industry, for instance, that have been terrible. And just because we like the industry or because we have a certain affinity for maybe the environment in this case or in this example, doesn't mean we should invest our money in investments or not sell investments because they're doing poorly. Another example having nothing to do with money is, people having an affinity for something. They'll buy an expensive bottle of wine that sucks. It's just a terrible bottle, but they'll buy it anyway because it's expensive, almost like to show it off. Consequences to affinity bias are things like, investing in luxury companies for the status versus the actual true strength of the investment. So I've had people come into our office. It's been a while, but years ago, and they'd say, well, I own Berkshire Hathaway. It's like, well, I don't, Berkshire Hathaway. So you own Warren Buffett's company. is that a good thing? I mean, I could show you times when Warren Buffett has drastically underperformed, but because it's Warren Buffett, it's okay and it doesn't matter, I guess. Well, obviously, I hope you would agree that's not true. It does matter. But owning Tesla because Tesla's cool, or owning Bitcoin, or wanting to own digital assets because it's cool, when maybe you don't understand those investments, or maybe they're too volatile for you. Another consequence is having an affinity for your local country and not being willing to seek other geographical locations when it makes sense to do so. So I mentioned how the U.S. has been outperforming international stocks for 13 years now. Well, back between 2002 and 2007, 2008 or so, international stocks beat the crap out of U.S. stocks. And the best place to invest from an equity standpoint was overseas. And once you go overseas, there's all kinds of countries we can invest in. And some people feel like, you know what, I only want to invest in the U.S. because I'm comfortable. Well, that might be detrimental to your portfolio. And then the last consequence here for affinity bias is it can cause investors to invest in sophisticated investments because they sound cool again, that are inappropriate, whether that's due to liquidity, in other words, they don't have enough money and shouldn't be investing in it. They don't have enough capital. They don't understand the potential outcomes because maybe it's a complicated investment. Examples of investments like this might be alternatives. Alternative investments like big oil and gas. I mentioned limited partnerships earlier that might have great tax consequences, but they might be a really, really long-term hold where you can't sell it and you're stuck with it for a long time. And so if liquidity is a problem, now we've got a problem. If we don't have enough money and we need to take money out of our portfolio to supplement our income, but we put too much money into an illiquid investment that we don't understand, or worse, something happens in the market and this long-term hold doesn't work out temporarily, so something happens in the world that causes that investment to temporarily go down. Now we've got a problem because we're freaking out about that investment, and maybe we want to get rid of it because we don't have enough other money to supplement our income. So buying an investment because it's sophisticated and it makes us feel good, having an affinity for things is obviously not a good reason to buy things or own any investment. So that's affinity bias. So a couple final thoughts here. We've gone over all these cognitive and social biases. The problems, obviously, are that emotional biases can't be fixed. Again, you just have to be aware of them and know that know yourself, know who you are, and keep those things in mind when you're making investment decisions. Cognitive biases, on the other hand, they can be fixed over time. With proper training, practice, we can fix those things. The solutions, so how do we fix them? First and foremost, I already mentioned, know yourself. Know which of these biases we've just gone over apply to you. And once you know what those biases are, write down your tendencies and be aware of them whenever you're making decisions. And this goes for cognitive and social biases. From there, in terms of fixing those cognitive biases, create rules for your investing and then follow the rules. I know several people who have rules. Well, I know most people don't have rules, period. They don't have any. And then for the people that I know that do have rules, oftentimes they don't follow them. And if you don't follow your rules, why have rules at all? They're pointless. So you got to create rules for your how you're going to invest your money, your retirement portfolio, and then you got to follow those rules, of course. And then last but not least, when you don't follow the rules, when things don't work out in your favor, whether it was in your control or not, and most times, it is in your control, again, to follow your rules. There are no such thing as mistakes. There's only lessons, unless you continually keep making the same mistakes over and over again. So always keep in mind that this is a marathon. It's not a sprint. So I hope that today was fun. I hope you learned a lot of things about biases, and I'd be curious to know if any of you want to shoot me an email at adam@libertaswealth.com. I'd love to hear from you and hear which biases apply to you. And if you want to chat on the phone about it, I love this stuff when it comes to psychology. But I'm going to go ahead and end there for today. That's it for today's show. Feel free to share this episode with your friends and family if you think they'd enjoy it. And if you'd like to discuss your personal situation further, your retirement plan, investment management, please remember you never, ever, ever have to be a client to ask a question. If you'd like to set up an introduction call or Zoom meeting, just head over to our website and you can schedule something in our calendar. Shoot us an email and Kim will help take care of you, or Gina. As I always say, there's thousands of podcasts out there, and you chose to give ours a listen today. So thank you so much for tuning in. Again, be sure to subscribe on iTunes and YouTube. And remember, you can sign up at libertaswealth.com to not only get these updates, but also our other screencasts, videos, and articles that we write delivered directly to your email inbox. Feel free to follow us on Facebook at facebook.com/Libertas Wealth. Again, I'm also on Twitter at Adam Koos, and I'm on Instagram at Financial Surgeon. So thank you so much once again for joining us, and we'll see you next time.
Thank you for listening to the Cash Podcast with your financial surgeon, Adam Koos. To see any charts or images that were mentioned in this show, or to check out additional articles, videos, and other educational resources, head over to libertaswealth.com.